Great, thanks for the introduction, Harry, and welcome to the call, everyone. Just wanted to take the opportunity to remind you that for some time now we produce a comprehensive monthly report. Sorry, there was an interruption. Just to kick off, I just wanted to take the opportunity to remind you that we now produce a comprehensive monthly report and not a quarterly report as done previously, which hopefully provides you with more granularity between these quarterly calls. For the call today, I'll go through the market performances for the quarter and then move on to the key developments in our main markets over the period. I'll close with our outlook for the companies and markets we're invested in. The third quarter, as you would have seen, was an exceptionally weak one, largely due to very poor sentiment towards emerging markets. For the quarter, in USD terms, Nigeria was down 15%, Kenya was down 14%, Egypt down 10%, and Botswana down 9%. With the only gainers being Zimbabwe, up 8%, adjusted for the old neutral rate, and Mauritius plus 1%. Encouragingly, with the exception of the Zambian kwacha, currencies in our main markets held firm, which we attribute to the substantial improvements in country balance sheets and the significant increases in FX reserves over the last 18 months, particularly in Egypt and Nigeria. Moving on to the individual countries, I'll kick off with Nigeria. In addition to global events in the quarter, the upcoming Nigerian election, scheduled for February next year, cast a shadow over the market. There were a number of high-profile defections from the ruling APC to the opposition PDP party, which dashed any hopes of a smooth one-horse race. The opposition leader has now emerged, and its ex-Vice President Atiku Abubakar. Concerns about what the election outcome means for Nigeria are met with a consistent answer from locals and people in the market, which is look to the team. That reference to the team being the cabinet that each candidate is likely to select, particularly in key posts like finance and oil minister. This reinforces our view that African governments are becoming increasingly technocratic, and that voters, and for that matter investors, are not really being faced with radically different economic ideologies such as capitalism and socialism. What is good is that both candidates are now acknowledging the challenges Nigeria faces, namely stability in the oil-producing delta, security in the north, and diversifying the Nigerian economy away from oil, which is certainly a good start. Macroeconomic data in Nigeria over the quarter remains mixed. PMI was above 50, and inflation continued to fall, although it is starting to flatten out. However, feedback from consumer companies suggests that the consumer is still under pressure. The timing of an improvement in consumer disposable income is not clear, but we think increased oil production on increased crude prices equals more government revenue and expenditure, which ultimately has to filter down in due course. Demand for data on the continent is insatiable, and Nigeria is no exception. Broadband connections continued unabated, and in August alone, 1 million new connections were made in Nigeria, with the total for 2018 likely to be well north of 10 million. A staggering figure when you think about it in absolute terms. Although gradual, some of Nigeria's policies and reforms are starting to pay off. Cement volumes are up above 10% in the 9 months to September, and we note that Nigeria is now fully sufficient in and has already started to export cement. We estimate the move to self-sufficiency has saved the government $2 billion a year, which is roughly 5% of valuable FX reserves. This is, however, small in comparison to the savings when the new oil refinery comes on stream at the end of 2019, where Nigeria will shift from one of the world's largest refined fuel importers to a net exporter. Another interesting topic, pension assets are getting close to $25 billion from single-digit billions a decade ago, and that's as a result of the pension reforms of 2005. I think importantly, the point we want to make is that these are all long-term policy successes that have spanned multiple governments, elections, and presidents, and really talk to the increased technocracy that I mentioned above. Moving on to Egypt, the latest data out of Egypt indicates the economy is growing at a real rate between 5 to 6%. We believe this is still phase one of the post-devaluation recovery, where the consumer is repairing balance sheets and credit growth is mostly working capital financing. Inflation has fallen but remains stubbornly above 10% as the government continues to roll back its expensive subsidy program. Our recent visit to Egypt confirmed that consumer staples, banking and healthcare is strong. However, discretionary spend has yet to pick up. The fund remains for now exposed to the former. Phase two of the recovery should see increased capital expenditure by corporates, part of which should be financed by credit, which will obviously open up new avenues of revenue and higher yields for the commercial banks. It was very encouraging to see the announcement in the local press today that PepsiCo, the multinational beverage and snacks producer, is planning to invest $500 million into increasing production and boosting distribution capability in Egypt. So perhaps that's certainly a good start from the sort of large corporate side. Moving on to Kenya, unfortunately the highlight in Kenya this quarter was the passing of the Finance Bill into the Finance Act of 2018, where politics clearly trumped economics. MPs decided not to repeal the damaging interest rate caps, and at presidential assent, the bill imposed a number of taxes and levies on telecoms and banking services, including an increased levy on mobile money transactions. Despite this, we continue to position the portfolio to capture the growth in mobile money and the exponential demand for data. Kenya, like the rest of Africa, does not have a legacy fixed line network, and therefore the opportunity to provide broadband to phones, homes, and businesses is immense. Moving on to Zimbabwe, the long-awaited elections in Zimbabwe saw the re-election of incumbent Emmerson Mnangagwa. These elections were given a lukewarm acceptance by international observers. Either way, we now have an elected government with a mostly technocratic cabinet and I believe a very clear mandate. However, as is often the case, it's only now that the real challenges are brought to bear. And none is more pressing than the lack of USD liquidity and the large debt burden the country faces. What Zimbabwe now needs is working capital. We continue to believe that this will at least be partially obtained. Notwithstanding this, we maintain our conservative stance in the country and are invested in those companies with sufficient cash reserves and proven business models. In terms of outlook, our outlook for the continent and the capital markets, we continue to invest in companies with strong underlying operations. These companies are well funded and tap into demand for data, non-cash payment like mobile money, healthcare, fintech, financial services, and food and beverages. In terms of politics, despite some uncertainty and challenges, as mentioned previously, we really do welcome more technocrats and more technocratic governments. The finance ministers of the majority of our markets now have impressive CVs, most holding international qualifications and have relevant experience in both the private and the public sector. So that certainly fills us with a great degree of confidence around politics, around macroeconomic policy, and especially following the dramatic price falls over the last quarter. Needless to say, we remain incredibly bullish about the sort of the outlook for the markets and the outlook for our funds. At this point, I'll hand back to Harry or the floor just to see if there's any questions for us to field. Yeah, Craig, I'll leave this one up to you. Thanks a lot.